Nothing I share here is financial advice. This is all based on my own experience, my strategy, and how I see the market. You're responsible for your own trades, so always do your own research, manage your risk, and never trade money you can't afford to lose. This content is meant to help you learn and think for yourself, not to copy or follow blindly. Let's keep it educational and intentional. Hello guys, let's have a look at the yearly chart. Here I have the previous year. The 50% level means the middle of the candle. We can see that price is currently rejecting from this area, and yesterday it hit the yearly open. We had a poor low at the yearly open, which is now cleaned. Still, more or less, it's only a small wick and none of the expected levels have been hit so far, and by that I mean the 50% levels of the wicks. Keep in mind, everything here is set on the log scale. The same applies to the Fibonacci settings. You can switch this in the settings. You'll find it at the bottom. We marked these levels out after the yearly close. I still want to see those levels get cleaned. If price comes down first, that's where I would look for a trade, aiming back up toward the opposite level. On the upper side, I would look to take profits slightly above this level and then start looking for signs of weakness. For that, we'll use the metrics I already shared in Telegram, along with some other tools. If there is weakness, I will look to scale out of bigger spot positions. If there are no signs of weakness in the metrics and tools, then I would most likely look for higher prices. Another thing we can do is treat last year's candle as a yearly range. We've already marked it out and are using the 50% to see where the midpoint is. But like every range, we also have a high and a low. That means an SFP or deviation of the range is possible, an SFP on either side. If that happens, there is actually a high probability that price does not take out the opposite side within the same candle. That means if we see the low swept based on history, there is currently a 0% chance to take out the other side, because none of the yearly candles have ever done that. Of course, we don't have many yearly candles, so the statistics might have less weight, but as it stands now, we've never seen it happen. So if one side gets taken out, I will be cautious about aiming for the opposite side. Price can come very close, of course, but for me, that would be the moment to think twice and look for weakness. The same goes for the upper side. If Bitcoin takes out the high first, then there's a small chance to take out the previous yearly low, which is around 74K. That would mean either more upside or a range for another year before the low gets taken out. So definitely two interesting levels, I would say. I'm excited to see that play out, of course, but only time will tell. Until then, we have the levels in the mid areas, and we have the 50% of the wick, which is not a level to the dollar. It's simply a Fibonacci retracement to measure how far the retrace happened. From there, we zoom in and look for local levels in these areas, and for that, we switch to the lower time frames. So, looking at the 50% areas of the previous year, we can see that they line up very nicely with several important levels. The lower one sits right at the overall low of this move. That means if price comes down into this area, we could get a possible SFP scenario. As confluence, we can use the filled wick, mainly the 50% level. Price can of course wick lower into it, but as long as we do not see a weekly close below this low, it remains a higher low. Only if we start to see weekly closes below it, then at that point I would think price is going for a retest of the monthly main structure swing low. At that stage, we are clearly not forming a bottom from this level, and we would have to look for the next level, which would be the 4-day order block. So, more or less, we now have two important levels. Do not lose the last low on a weekly close basis. If that happens, I would most likely not look for longs until the next bigger area. And if that scenario plays out, price would take out the low of the previous yearly candle. As explained before, that would reduce the chances of taking out the high in the same year. In that case, we would need to wait at least another year, where we either see a full range again or price moving lower. On the upside, we also had a few levels. I've removed some of them now, so the chart is cleaner, but we still have the 112K target based on one strategy, a weekly breaker and a weekly order block in that area, the daily structure swing low, and overall a lower high area on the weekly time frame. Most of the time, price comes back to test the order block. Not always, but very often. And that area on the upside is the same zone where the 50% of the wick is located. So what we see is that starting from the yearly chart, where we only used a few Fibonacci levels, once we go down to the lower time frames, we can clearly see that there are real, well-defined levels at those exact areas. That makes the 50% level a very nice confluence with local structure. Now the next step is to look at what is happening time-wise and how price behaves around these levels. We are coming into the daily cycle low time window. My indicator is not working right now. I don't know why. However, the daily and lunar cycles that I marked out are very similar. As we can see now, we are entering that date. It's not always exact to the day. We always have to allow for deviation, either to the left or to the right. Usually, if it happens around the date, a few days before or after is totally fine. What's important is to look for an area where price is hitting a meaningful level, whether that's resistance or support. In our case, right now, price is hitting the 2-day order block that we already marked out. While this is happening inside the time window, I am looking for longs. I would be okay with another SFP of the current lows. I would even be okay with an SFP of the previous month's low, or even the overall low, if that happens inside the time window where a low is expected to form. You can see how important time is here. However, based on the candle statistics that I showed for the month, there is a low probability that the previous month's low gets taken out. Yes, low probability events can happen, of course, but as long as they don't, I have to go with the higher probability scenario, which shows that in about 95% of cases, that low does not get taken out. So when I combine the support level we are at right now, the 2-day order block, potential liquidity below if a sweep happens, the low probability of taking out the previous month's low, and the timing window, the conclusion has to be that I'm looking for longs. Based on the candle stats, there's roughly a 6% chance that I'm wrong, but I would still look for a long because of the timing. This is usually exactly where people are most bearish. You can check almost every lunar time window I've marked out. In those areas, most people are looking for lower prices, and I usually do the opposite. We're also getting closer to FOMC next week and the monthly close after that. If we don't see a real move soon, then we have to be ready for a new move starting next month. But as of now, the timing is good. So for me, I stay in my spot positions and my leverage trades for now. For the leverage trades, I will allow an SFP of these local lows. If price starts to lose this level, I will close them and look for the next levels below while keeping the spot trades open. The last spot entry is on the 12-hour time frame. I already have one from the lows, and now we've had another trade trigger here as well. Here we are on the 12-hour time frame, and this 12-hour setup is extremely rare across the entire history of Bitcoin on ShopBuyABit. Over the last 8 years, this setup has triggered only 16 times. And by the way, if we look at the cycle timing, I can see that many of these triggers happened very close to the same timing windows in the past. Let's look at a few examples. First, the longer duration trade. This was a case where price was more or less bought in one move near the lows. Not the absolute low, but after one more leg down, it eventually turned out to be the bottom. However, price needed much more time to come back to those levels. So this is clearly a trade where you had to hold for longer. To be fair, most of the time these setups resolve faster, but this example shows that patience can sometimes be required. Now looking at the other trades. When we say 16 trades, that's actually 16 entries, not 16 independent trades. The bigger trades had all compound entries filled, so one setup could show 5 entries, 5 trades, but in reality, it was one single position. If we treat it that way, then this 12-hour setup has only occurred 8 times in the last 8 years. That makes it even rarer. What we usually see is the following. The setup forms near the lows. Often inside a range, a trade triggers close to the low itself, plus or minus some deviation, and then we see a move back up. Sometimes this happens inside a range, and in a bear market, it can take longer and even move lower first. If we look at the last example, we see a very similar situation. Price is ranging, the trade triggers near the low, and then we get a reversal back toward the high. Now looking at the current setup, it looks very similar to those past cases. Of course, the big question is whether price reverses from here or whether this becomes one of the lower probability scenarios where it takes more time and maybe goes lower first. And again, this is where timing becomes extremely important. If we switch back to the lunar timing, meaning the daily and weekly cycles, we can see that these setups often appear right inside the correct time window. That's another strong confluence for along in my view. In most cases, we've seen faster reversals, and only in the lower probability scenarios does price go lower first before resolving higher. Now, with that context in mind, let's look at the statistics on this setup. And here I just chose the period after the bear market, because if it's a pure bear market move, this setup will usually go lower anyway. But that is actually not what happens most of the time. After 2023, we saw several ranges and some clean setups where price simply formed a bottom and moved up. What we have here is an average move of 12.55%. That's something we can project on the chart. The average time for the trade to play out is around 61 bars. Yes, that's a bit on the longer side, but if we take a range environment into consideration, it makes sense. Given that we are entering the daily cycle low time window, the move can also happen faster, just like in the previous examples. A 12.55% move from here would bring price to roughly 102K. That's not the trade target itself, of course, because the actual target would already be hit lower, around 95.5K. But it shows that the follow-through move after such a setup is very realistic. If we take the 61 bars average, that would align almost perfectly with the next lunar time window, meaning roughly 1 month from now, toward the end of February. And interestingly, that's also where we would normally expect another potential low, unless we get one of those situations where price rallies into the time window. If that happens, then it becomes a potential short setup for me, ideally after first tagging 112K. That's exactly what I'm currently watching. Now I'll update the local levels and see if a clean setup develops or not. For more detailed insight, you can of course join the shop Patreon. For now, I've explained the bigger picture, what I'm looking for on the lower timeframes, and the setup I'm currently in. If you want access to this strategy, it's also available via SA Telegram when you join through Patreon. Until then, I wish you a great day, and I'll see you in the next one.